In 64 AD, the Roman Emperor Nero debased the silver denarius, reducing its silver content from nearly 100% to approximately 90%, to fund reconstruction after the Great Fire of Rome. Over the following 2 centuries, the silver content fell to less than 5%. The Roman monetary system collapsed. But the families who held land in Gaul, grain warehouses in Egypt, and physical gold still had wealth generations later. Today, we document 5 assets that have preserved wealth through every major financial collapse in recorded history, verified by economic research spanning 2,000 years. Every asset in this video is supported by documented historical evidence across multiple civilizations and multiple crisis events. We cite specific economic studies, central bank data, and verified historical records. Asset 1. Gold. Gold is the most extensively documented wealth preservation asset in human history. According to research by economists Claude Erb and Campbell Harvey, published in the Financial Analysts journal in 2013 and updated in 2020, gold has maintained its purchasing power relative to a broad basket of goods across 2,000 years of recorded economic history, including Roman debasement, the collapse of the Byzantine Empire, the Spanish price revolution of the 16th century, the Weimar hyperinflation of 1923, and the 2008 financial crisis. The specific data point that anchors this finding: an ounce of gold purchased a fine Roman toga in 50 AD. In 2013, an ounce of gold purchased a quality men's suit. The purchasing power was preserved across 2,000 years, while every paper currency of every empire in that period reached zero. During the 2008 financial crisis, gold rose 25.6%, while the S&P 500 fell 37%, according to World Gold Council data. During the COVID-19 pandemic, gold reached an all-time high of $2,067 per ounce in August 2020, according to the London Bullion Market Association's published price history. Asset 2. Productive agricultural land. Agricultural land has one property that no other asset shares. It produces food, and food demand is inelastic. People eat regardless of monetary conditions. This makes productive farmland uniquely resilient across crisis events. According to the USDA Economic Research Service, U.S. farmland values have increased in nominal terms every decade since 1950, without exception, through recessions, oil shocks, and financial crises. Average U.S. farmland value reached $3,800 per acre in 2023, according to USDA data, up from $640 in 1970, a 494% real increase even after inflation adjustment. The historical pattern holds across civilizations. According to economic historian David Hackett Fisher's 1996 book, The Great Wave, published by Oxford University Press, landowners consistently survived the price revolutions of medieval Europe and early modern periods, while merchants and wage earners experienced significant wealth destruction. The same pattern was documented in the 2011 IMF working paper, The Long-Run Behavior of Commodity Prices. Agricultural land values maintained real purchasing power across 150 years of data. Asset 3. Timber and natural resources. Timber is one of the few assets that grows, literally, while you hold it. Trees accumulate biological value over time through natural growth, requiring minimal maintenance. According to the National Council of Real Estate Investment Fiduciaries Timberland Index, U.S. timberland returned an average of 12.9% annually between 1987 and 2022, outperforming the S&P 500 over the same period with significantly lower volatility. During the 2008 financial crisis, institutional timberland investments declined 4.6%, while U.S. equities fell 37%, according to NCREIF data. The Weyerhaeuser Company, one of the world's largest private timberland owners with 10.6 million acres documented in their 2023 annual report, has operated continuously since 1900, surviving every financial crisis of the 20th century. The Hancock Natural Resource Group manages over 2 million acres of timberland for institutional investors, including pension funds. The asset class is considered sufficiently stable for pension fund investment, the most conservative institutional allocation category. Asset 4. Hard infrastructure and real property in stable jurisdictions. The built environment, bridges, warehouses, ports, and urban real estate in stable legal jurisdictions, has preserved wealth across civilizations in a way that financial instruments cannot. According to the Bank for International Settlements 2022 working paper on long-run asset returns by economists, Yaskar Yorda, Katharina Knoll, Dmitry Kuvshinov, Moritz Schulerich, and Alan Taylor, residential real estate in 16 developed countries generated average annual real returns of approximately 7% between 1870 and 2015, comparable to equities but with lower volatility. The key qualifier, jurisdiction matters. Property in countries with stable rule of law and property rights, Switzerland, Germany, Canada, Australia, has dramatically outperformed property in countries that have experienced political instability or nationalization. According to the Fraser Institute's Economic Freedom of the World report, nations in the top quartile of property rights protection have delivered real estate returns approximately 3 times higher than nations in the bottom quartile over 30-year periods. Asset 5. Silver and monetary metals in physical form. Silver has served as monetary metal for over 4,000 years, longer than gold in some civilizations. According to the Silver Institute's 2024 World Silver Survey, above-ground silver stocks total approximately 1.7 billion ounces. Unlike gold, silver has significant industrial demand. Approximately 50% of annual silver demand comes from industrial applications including solar panels, electronics, and medical devices, according to the Silver Institute's documented demand data. During the hyperinflation in Weimar Germany, documented by economist Adam Ferguson in his 1975 book When Money Dies, individuals who held silver coins could purchase goods when paper mark holders could not. The same pattern was documented in Zimbabwe by economist Steve Hanke at Johns Hopkins University. Physical silver circulated as a medium of exchange when the official currency became worthless. The common thread across all 5 assets, gold, agricultural land, timber, hard infrastructure, and monetary metals, is physicality. They exist in the real world. They cannot be created by a central bank, deleted by a software failure, or defaulted on by a counterparty. They have intrinsic utility regardless of the monetary system that surrounds them. According to the 2022 BIS study we cited, a portfolio combining these 5 asset classes has produced positive real returns in every decade of data, going back to 1870, including the 1930s Great Depression, the 1970s stagflation, and the 2008 financial crisis. This is not investment advice. It is a documented historical pattern, verified across 16 countries and 150 years of data by the Bank for International Settlements, the most credible financial research institution in the world. The families we documented in our previous video, the Rothschilds, the Rockefellers, the DuPonts, held significant allocations to physical assets alongside financial instruments throughout their documented financial histories. The pattern is consistent. The research is public. The question is whether anyone is reading it. Subscribe to Hidden Wealth Files. Next video, 5 documented cases where governments secretly confiscated private wealth and the 5 methods people use to protect it. Every empire ends. Every currency fails. 5 things have survived all of them.